Hi everyone, Nick here. Welcome back. The stock market has recently reached all-time highs. This has caused some people to express concern that they may be getting overconfident and wondering if it's time to reduce risk. I've seen others argue that the data shows 100% stocks has done the best historically, while others even argue that 100% stocks is reckless, similar to driving without a seatbelt. Deciding your asset allocation is a very important decision. Some studies show asset allocation is responsible for over 90% of portfolio returns. In this video, we're going to look at the arguments for and against 100% stocks. We'll look at it from 2 points of view. First, for people who are still accumulating, and second, for retirees. First, we're going to look at 100% stocks on the happy path. I'm a software engineer, and we often use this term happy path to discuss when everything is going as planned and nothing unexpected happens. So let's look at some data from Vanguard. This is the range of returns from 1926 to 2022 for various portfolios, starting on the left with 100% bonds, and then going all the way up to 100% stocks all the way to the right. And we can see that the 100% stock portfolio had the highest return at 10.2%. Then as you go down to say an 80% stock, 20% bond portfolio, it drops to 9.5%, and then 60% stocks, 40% bonds down to 8.6%. We all know that compounding amplifies these small differences over time. We can also see that the deviation of returns with the higher stock portfolios is higher. So it means the portfolio will swing more each year. Like the best year was 54% gain with 100% stocks, but a 43% loss in the worst year. And then as we add more bonds, it decreases the swings in both directions. There's less upside, but also a bit less downside. Now let's look at the happy path in Google Sheets with these statistics. We can look at someone starting with $50,000 and adding $2,000 per month. If we take the average annual returns for these various portfolios from 100% stocks down to 60, we can see that after 40 years of investing $2,000 per month, the 100% stock portfolio grows to $16.35 million, and the 60% stock portfolio grows to just under $10 million. It's a massive difference over 40 years. So for somebody accumulating, the happy path of 100% stocks is the most desirable outcome. Now we'll discuss the happy path for retirees. And for this, we'll use this glide path paper, An International Perspective by Javier Estrada. This is written in 2015. And he compares various asset allocations and glide path strategies. This includes decreasing equities, where you decrease the amount of stocks you have as you approach and then go into retirement. And then there's another strategy of increasing equities. So you would decrease the equities, have a higher percent bonds when you retire, but then every year during your retirement, you add more equities. That's called the increasing equity glide path. And then there's other strategies that are just static strategies, like holding 60% stocks, 40% bonds for the entire duration of your retirement. Then he also looked at 100% stocks. And he did this for rolling periods of 30-year windows over 110 years, from 1900 to 2009. So there's a lot of different simulations for all the different 30-year periods within that time frame. And he simulated a 4% withdrawal rate to look at statistics on the success rates and different portfolio values at the end of the retirement. Let's look at the data. The most interesting result, in my opinion, is on page 14. And this is where he compares the 100% stock portfolio over 30 years to the best dynamic strategy. That's with either the decreasing or increasing equity strategy that was best, the best static strategy, which could be like 80% stocks for the entire retirement, and the 60% stocks for the entire retirement. So he compares this for the USA and the world portfolio. And the failure rate is the number of times that this portfolio ran out of money, the percentage. actually. So we can see that 100% stocks actually has the lowest failure rate, tied with the best static portfolio in the USA. And in the world, it's actually slightly better, lower failure rate than the best static portfolio. Then if you compare the median and mean values of the portfolios after 30 years, the 100% stocks did better. And then in the best cases, it did far better, leaving a lot more money at the end of your retirement to leave to your heirs. This is just one study of many. I like that it uses the world market instead of just the US data. There are many variables you need to consider when planning retirement withdrawal strategies. I've talked a lot about them in other videos and different tools like Monte Carlo simulations you can use to estimate failure risks. And that's with tweaking the withdrawal rate, the duration of retirement, and some other factors. This is just looking at a 30-year retirement with 4% withdrawal rate and comparing these different strategies. It's really a lot more complex than that, but this does question if 100% stocks could be the best strategy for some retirees. This is against the traditional financial advice that is based on glide paths, and few advisors would recommend 100% stocks to a client. Before we get to the unhappy path, I just want to thank you for your support. I appreciate it if you smash the like button and subscribe to help support free financial education. Now let's look at the unhappy path. You only get one retirement, so your retirement experience may not match that of the average of 100 years of data. First, I want to discuss loss aversion. This is from a study from Nobel Prize winning psychologists. What they learned was that people experience the pain of losses far more than they do the benefit or joy of gains. And that's what this chart reflects. You can see that at a 5% gain, people might feel a 17 unit of value benefit, but then for a 5% loss, it's a negative 41 unit of value loss. And you can see that that's more than double the pain of a loss than the benefit of a gain that people felt in their study. Now, this relates to asset allocation in that when people see the value of their portfolios plummet, it's a lot more painful than if it goes up a little bit more. And I think it really starts to taper out too. The benefit of additional gains when you already have enough money definitely diminishes. So for those who are retired and already have enough money, do they really get that much feeling of a benefit when it goes up by more? This data suggests that they don't. Next, I want to look at a portfolio visualizer for someone who is accumulating wealth, starting with $50,000, contributing $2,000 per month, inflation adjusted, and rebalancing annually. So for this person, they started in 1987. And then by year 2000 in the dot-com bubble, they saw 3 years of steady losses with basically any portfolio. Any of these 100%, 80 or 60% stocks. Now think about how you would feel if this was you. You've been saving and investing for almost 20 years. And then you've built up this $1.2 million portfolio. And then over the next 3 years, you're continuing to save and invest and work towards your retirement goal. And now your portfolio value plummets to $680,000. You've lost half the value and you've been contributing $2,000 per month. How would you feel? Would you feel very confident in this strategy? Would you sleep well? And then say you did manage to stick through it and you continue and it recovers, and then the financial crisis in 2008 happens, and now after another 6 years of staying the course, continuing to invest $2,000 every month, you're right back to where you were at the bottom of the bubble pop in 2002, and you're actually right back to where you first got in 1997. So you've gone over a decade contributing $2,000 per month, and you have made no measurable progress in the terms of your portfolio value. How would you feel? Would you feel very confident in this? Or would you just say, hey, the numbers historically for 100 years are there, and I'm going to stick with those averages, and I'm going to bet on that reoccurring. If you did, we all know that that would have worked out well, and several years later, you would have outperformed what would have been the 60% stock portfolio in this case. But that wasn't always the case, and it would have been a very wild ride. Now I want to look at someone who is retiring at one of the worst possible times in the past 30 years. And this would be right at the peak of the dot-com bubble. And they retire with $2 million, withdraw $20,000 per quarter. It's $80,000 a year, 4% of $2 million. Now they work their entire life to build up this nest egg and enjoy retirement. Maybe they even sacrificed a bit so they could retire early, and they're looking forward to a long retirement. And just over 2 years into that retirement, September 30, 2002, the value of their portfolio plummets by over 50%. How would you feel? Would you feel confident in your retirement strategy at that point? Would you be thinking about going back to work? Would you be sleeping well? Would you feel comfortable actually enjoying all the money you spent your entire life to build? And say you somehow did stick through it, and then just over 9 years into your retirement, the portfolio value has plummeted by over 70%. Now, how would you feel? You still have 20 years or more of possible retirement to enjoy, and you've already lost over 70% of your money. I wouldn't feel very good about that. I don't know about you. I don't know if I'd find too much comfort in the fact that 100 years of historical data says the average should be better and that I should stick with it and eventually things will be better. I might, but I actually don't know how I would feel. That'd probably feel pretty bad. So even though the data shows that 100% stocks should be the best at growing and possibly even maintaining wealth, that assumes that you can stay the course and rebalance every year. There are periods of time where 100% stocks will not outperform. It could be a decade or more. And that asset allocation requires an iron stomach. And this is where we get into numbers versus reality, or intellect versus feelings. There is an unknown future, and these drops always come with pessimism and extreme events, something that's never happened before. Things are never going to be the same. There's a lot of anxiety. And are you actually going to be able to stick with those numbers and stay the course and rebalance after seeing these massive drops in the portfolio? Are you going to experience the loss aversion and possibly change your asset allocation at just the wrong time? Something that happened to a lot of people during the financial crisis in 2008, even those with less than 100% stocks. We're really feeling that pain. And at some point we have to ask ourselves, why are we doing this? And what is enough? What are we optimizing for? Are we trying to get the most wealth as fast as possible? Or are we trying to spend the most in retirement, make the most donations, and leave the biggest bequest to our heirs? Or are we just trying to live a comfortable retirement and enjoy it? You can certainly reach your goals with 100% stocks or 60% stocks or less. It may just not be as optimal. It may take a little more time. Maybe you have a little bit less money. But as we saw from the loss aversion research, as people get more and more in the gain, the value of the additional gain is less and less. So if you've already built up a major portfolio, are you actually going to feel as good about growing it by more? Odds are that you probably won't feel quite as good going from 2 million to 4 million as you would feeling bad about going from 2 million down to 1 million. You have to think about that. Now, some people argue that 100% stocks is unnecessary risk. And as I mentioned in the beginning, some people even argue it is reckless. They argue that most people just want to reach their goal with more comfort and peace of mind and cannot stomach 100% stocks, and that extra return isn't even that significant or worth it due to this loss aversion or possibly abandoning your strategy in the middle of the downturn. So for an accumulator, it may mean working a little bit extra, and I want to show that. So this is someone starting with $50,000, investing $24,000 every year, trying to reach a goal of $2 million for their retirement. Now with the 100-year historical averages of these different portfolios from 100% stocks down to 60% stocks, we can see that with 100% stocks, it took 21.2 years. With 60% stocks, it would take 23.5 years. Again, this is unlikely to match exactly the 100-year historical average for you, but this might be a good benchmark to think about. If you were to get the exact 100-year historical average, you could take a lot less risk, see a lot less volatility in your portfolio, and you'd only have to work an extra 2 years. You're still able to reach retirement in 23.5 years, which is pretty damn good. Now for a retiree, you likely already have enough, and your goal has probably shifted from growing wealth to living off the wealth and preserving it. You likely want to avoid major losses, sleep well, feel comfortable spending your money and enjoying your retirement. Now, if you were to adjust other aspects of your retirement plan, such as a slightly lower withdrawal rate, slightly lower spending, or leaving a little less to heirs, you would also have a very successful retirement. I think there is some merit to the argument that it is unnecessary to have a 100% stock portfolio, but it does really depend on your goals. If you're just trying to get to the destination, live comfortably, and so on, you certainly don't need 100% stocks. So what do you think? I'm interested to hear in the comments below. Is 100% stocks unnecessary or even reckless? What is your asset allocation and why? My wife and I are currently 100% stocks. When we started investing, we had around 20% bonds. We weren't really sure how we would feel during a crash. During the COVID crash, we rebalanced from bonds into stocks. And then we used the rest of the bonds for a down payment on a house. We felt very confident doing that. And then when the market went down over 20% in 2022, we kept investing every paycheck just like we were before. My wife and I are comfortable with the risk. We're young and we have a lot of human capital. We're even excited to buy stocks at a discount. We currently plan to switch to 75 to 80% stocks during our retirement. We anticipate it being far less comfortable to watch our portfolio plummet while we're no longer earning an income. We won't have any money to be excited to buy stocks with when they drop, unless we can use the 20 to 25% bond allocation to provide that comfort and some assets to buy stocks when they're on the discount. Now, our plan may change, but this is our current plan. Thanks for watching, everyone. Again, let me know in the comments below what you think. Make sure to smash the like button and subscribe to support free financial education. Later.